Good morning and welcome back to Almus Market Mornings, your daily dose of global financial update. Friday came in at a lot of surprise for markets. The unexpected surge in the non-farm payroll, and that too by a big margin, led to a surge in dollar strength across the board. So, what do we now understand about the US economy? It seems consumer sentiment is positive, labor market remains tight. We are still seeing some decent growth. All this is, of course, pouring cold water of the aggressive rate cut betters. Good morning, JK. What's your take on the recent surge in dollar? How are you seeing things?
Good morning, Swaraj. Yeah, on the face of it, the jobs report was a blockbuster, no doubt. Job creation is almost doubling from what the market was expecting. Unemployment rate staying at 3.7%, and also wage inflation also going up quite a bit. So, the market in some quarters at least, there is a discussion which is shifting from soft landing or recession to no landing or reacceleration. That's how it is being seen, because if you look at the overall context of the US economy, GDP growth was at 3.3%. Compare it with Europe, which is still struggling, and then you had consumer confidence, which surged by 6 points to 114. Then this number. So all this is actually something not that can be correlated with the economy, which is slipping into a recession. So definitely economy is very strong, super strong, I would say. And relatively other economies are not doing so well. That's what I can read. Although there are some points to consider, like the number which is so high. Also, if you deep dive into it, you can see that it was major increase in the part-time employment. So part-time employment along with average work hours being less, which means that what probably one person was doing, now two people are doing, and that increases the number of people who are employed, obviously. And of course, wage inflation is something that you cannot explain it, but this also does not gel with the other reports that we have seen, that the employment component of the PMI services was lower. We had already seen ADP numbers, which was much lower. Challenger job cuts were higher, and quits rate in the JOLTS report was also lower. So there is definitely a conflict in the overall report, but market is inconclusive. And if you look at it, market was not well positioned going into this report. Euro was pushing higher towards 1.09 almost, and then yields were backing down despite all the good data that we had seen. And the number really rattled all these positions. So we got bond yields that have surged more than 20 basis points for the 2-year, now pushing above 4.40. And the 10-year also now more than 10 basis points. And significantly, yields are moving, even in the Japanese time, which means that all across people have been positioned on the lower side of the yields. And that's really upsetting the apple cart for the people who are looking for a quick rate cut by the Fed. FOMC had already poured cold water on a March rate cut. And on Sunday, in a scheduled interview also, Powell reiterated the same thing, although he did say actually that there was no change in the plan of rate cuts that was indicated in the December FOMC. So, but that did not help the market. Market is now realized that they have been wrong-footed, at least in the short term, as far as the positioning is concerned. That's the reason why we had a big drop in the euro, or rather the rise in the dollar index above 104. Dollar yen pushing towards 149. Perhaps a break can take it to 150. Overall, there are little reasons to sell the dollar right now, at least in the short term, until we get some more triggers. Next week, we will have the monthly inflation number, and that can serve as a stronger hint to see whether the rate cuts will happen early or not. Meantime, market discounting shows that even a May rate cut is now much less probable than it was being assumed a little earlier. So we have a situation of dollar continuing to be strong. Stock markets, of course, normally a strong report would have made, and also the rise in yields would have made the stock markets wobble, but that was not to be. They took heart from a stronger economy, and then tech earnings from some of the companies was good. And these are things that are somehow the overall market situation is not what you would normally expect. So that, and the positioning is selling upon the dollar as well as the bond market as well. Chinese yuan, again broke above 7.20. A strong report from US was all that was required for Chinese yuan to move above 7.22. 7.20 was strongly defended by the Chinese authorities. Now, last week we had seen Chinese market give up all their gains that was made on the back of the RRR cut of 1%. Now, the Chinese authorities have become very, very, I would say, very much concerned about the way the markets have moved. And there are some reports of rescue plans under the way, where China is moving to stabilize the market after the rout that was seen, last week. So I can expect some more measures from China. But overall, other markets are very perky now in terms of valuations, but still led by liquidity. Coming to our own market, the euphoria after the budget has somewhat cooled off on Friday, particularly with central, rather the state-run banks being seen on the bid in the USD/INR above 80 to 80. It had moved back to above 80 to 90. And then with this job report, we have seen in the offshore trade, it moved above 83 also. It ensures that, we are in the same range as far as the INR is concerned, although it's very unlikely that rupee will fall much despite dollar index strength. If you look at the last 1 year's price action, a dollar index moves much more both ways, and dollar rupee moves in the same direction, but with much less percentage. So that is likely to continue. Now, immediate direction for the USD/INR is a little bit up, but not too much. I don't think we breach 83.20 on the upside, and any return of weakness in the USD can take it towards 80 to 80. That's all that we should be looking at. But in the medium term picture, I think some more strength in the USD, particularly against the majors, is possible. At least one more percentage fall from these levels for euro and perhaps GBP as well. With the rupee being in the range, so you can expect a rupee to gain against other currencies like euro and GBP. So overall, I would put it this way, that it's not just the US exceptionalism that we are seeing. We are probably seeing the rupee exceptionalism also, or rather the Indian exceptionalism also, because the growth in India, the fiscal roadmap, which is very credible, possibilities of rating upgrade, strong flows, all these things make for a good path ahead for the rupee. Thank you.
Thank you, JK. And just quickly summarizing, the jobs report was a big positive for the US economy. So basically, low unemployment, job creations beating expectations, all of this is a little bit positive. But we also have to take into account the data released, the entire data released previous week. We had conflicting data with the ADP numbers and the job quits data coming in worse. So overall, it does seem somewhat like a mixed picture, and that led to not so pleasant market positioning ahead of the non-farm payrolls, and that's why we saw such a volatile move. From a March rate, and when it comes to rate cuts, March rate cut probability now, earlier and now even May rate cut probabilities are falling in the US. One important thing to note is due to Friday's dollar strength, Chinese yuan has started trading above 7.20. So that's one major factor. For India, it seems the after budget party has started to cool off. State-run banks continue to stabilize rupee at the lower levels, ensuring that we remain somewhat in a similar range. But as JK mentioned, we can expect to continue to remain in the same range with we can with any aggressive rupee depreciation being capped below 83.20. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.